Hello, traders, and welcome to another episode of Technical Edge. You're studying support and resistance. You're marking your supply and demand zones. You think you understand smart money concepts, but you keep getting stopped out right before price moves in your direction. Why? Because you don't truly understand liquidity, the single most important concept in smart money trading that 95% of traders get wrong. In this video, I'm going to reveal the true concept of liquidity that institutions use to manipulate retail traders, and more importantly, how you can use it to your advantage to increase your win rate dramatically. Stay until the end because I'll show you exactly where to find liquidity on any chart and how to trade it like the smart money does. Let's start with the foundation. What actually is liquidity? In simple terms, liquidity is a concentration of stop losses and pending orders at specific price levels. Think of it as pools of money sitting in the market, waiting to be collected. But here's what most traders miss. Liquidity is not just any random level. It's specifically areas where retail traders, the majority, place their stops and orders based on obvious technical patterns. Smart money, banks, institutions, hedge funds, they need liquidity to fill their large orders. They can't just enter massive positions without someone on the other side to sell to them. So what do? They hunt these pools of liquidity. They push price into these areas, trigger all those stop losses and pending orders, grab the liquidity they need, and then move price in their intended direction. Think of it like this. Imagine you're at a busy airport trying to exchange $1 million. You can't just walk up to one booth and do it instantly. There's not enough money there. You need to visit multiple booths, collect from different sources. That's what institutions do with liquidity. They collect it from concentrated pools. So liquidity equals fuel for the market. Without it, big players can't move. Understanding where this fuel is located gives you a massive edge. Now, here's where it gets interesting and where most traders get confused. Many traders use these terms interchangeably, but they're not the same thing. Let me break it down. Liquidity, as we just covered, is the actual concentration of stop losses and orders at a specific level. It's the target. It's where the pools of money sit. Common liquidity zones include equal highs, buy stops resting above, equal lows, sell stops resting below, swing highs and lows. Round psychological numbers like 1.1000, 1.2000. Inducement, on the other hand, is the bait. It's the setup that lures you into placing your order in the wrong place, right before smart money sweeps liquidity and reverses. Inducement is the manipulation. It's that little move that makes you think, oh, price is breaking higher, I should buy. Or it's breaking lower, I should sell. Right before you get wrecked. Liquidity equals the destination, where stop losses sit. Inducement equals the trap, the fake move that triggers you to enter wrongly. Picture this. Price creates equal lows. That's liquidity. Stops are sitting below those lows. Price then starts breaking down, creating a bearish structure. That breakdown, that's inducement. It's baiting breakout traders to sell. Then boom, price sweeps the lows, grabs liquidity, and reverses hard to the upside. Key insight. The smart money uses inducement to get you positioned wrong. So when they sweep liquidity, your stop becomes their entry. Not all liquidity is created equal. There are different types, and knowing which is which will change your trading forever. Type 1. External liquidity. External liquidity sits outside the current price range. These are your buy-side liquidity, BSL, resting above swing highs. Sell-side liquidity, SSL, resting below swing lows. When you see equal highs, that's buy-side liquidity, buy stops from breakout traders and stop losses from sellers. When you see equal lows, that's sell-side liquidity, sell stops from breakout traders and stop losses from buyers. Institutions love external liquidity because it's obvious, it's concentrated, and retail traders put their stops there religiously. This is low-hanging fruit for smart money. Type 2. Internal liquidity. Internal liquidity is within the current price structure. These are imbalances, fair value gaps, inefficiencies that price needs to fill, unmitigated order blocks. Think of these as unfinished business. Smart money often returns to these areas to clean up inefficiencies before making their next major move. It's like they left money on the table and need to come back for it. Type 3. Visible versus hidden liquidity. Visible liquidity. Obvious levels anyone can see. multiple touches of a level, textbook support / resistance, trend lines everyone is drawing, round numbers. If you can see it easily, smart money knows retail stops are there. Hidden liquidity, less obvious pools, highs / lows within consolidations, intraday swing points, liquidity between sessions, wicks that got quickly rejected. Advanced traders hunt for hidden liquidity because that's where less competition exists. When everyone is watching the daily chart swing high, the smart money might be targeting a 4-hour or 1-hour liquidity pool first. Type 4. Strong versus weak liquidity. Strong liquidity, formed after significant moves, multiple tests, or equal touches. Confluence with other factors, order blocks, Fibonacci, structure. Higher time frame levels. Weak liquidity. Single swing point with no tests. Lower time frame only. No confluence factors. Recently formed. Strong liquidity has a much higher probability of being targeted. Weak liquidity might get swept in passing, but institutions go out of their way for strong pools. Okay, theory is great, but let's get practical. Where exactly do you find liquidity when you're looking at a chart? Location 1. Equal highs and lows. This is liquidity 101. When you see 2 or more highs at roughly the same level, that's buy-side liquidity. When you see 2 or more lows at the same level, that's sell-side liquidity. Use a horizontal line to mark these levels. The more touches, the stronger the liquidity pool. Smart money loves running these levels because everyone sees them and places stops there. Location 2. Swing highs and swing lows. Any significant swing point where price reversed is likely holding stops. The high of a strong bullish move, sellers stops above. The low of a strong bearish move, buyers stops below. Pro tip. Look for swing points that led to strong reactions. The bigger the move away from that level, the more traders got trapped, the more stops are likely sitting there. Location 3. Trend lines and channels. Retail traders love their trend lines. They place buy orders at ascending trend lines and sell orders at descending ones. They put stops just beyond these lines. What does smart money do? They sweep just beyond the trend line, grab all those stops, then reverse hard. This is why false breakouts happen so often. They're not false, they're intentional liquidity sweeps. Location 4. Round psychological numbers. Big round numbers are liquidity magnets. 1.1000, 1.2000 on euro to US dollar. 100.00, 150.00 on pound sterling to Japanese yen. 2,000, 2,500 on gold. 50,000 on Bitcoin. Why this matters? Retail traders set pending orders at these levels. I'll buy when gold hits 2,000. They place stops at these levels. Stop loss at 1.0950. Smart money knows this and hunts these areas relentlessly. Location 5. Previous day / week / month highs and lows. Session highs and lows are major liquidity zones. Previous day high, PDH / previous day low, PDL. Weekly highs / lows. Monthly highs / lows. Asian session range highs / lows. Institutions often target these levels at specific times. For example, sweeping the Asian session low during London Open to grab liquidity before a major move up. Location 6. Obvious patterns. Any pattern taught in Trading 101. Head and shoulders, stops above the head. Double tops / bottoms, stops beyond the touches. Triangles, stops just outside the converging lines. Flags and pennants, stops beyond the pattern. The trap. These patterns work until they don't. Why? Because smart money knows where all the textbook stops are, and they sweep them before the real move happens. Location 7. Fair value gaps and imbalances. Price often leaves behind inefficiencies, gaps where no trading occurred. These represent internal liquidity pools. Price has a tendency to return and fill these gaps before continuing. Trading implication. Mark your FVGs. When price sweeps external liquidity and then returns to fill an FVG, that's often your high probability entry zone. Now for the money section. How do you actually use this information to make better trades and increase your win rate? Strategy 1. Wait for the liquidity sweep. Stop entering on breakouts. Instead, 1. Identify liquidity equal lows, for example. 2. Wait for price to sweep below, grab liquidity. 3. Watch for immediate reversal with strong momentum. 4. Enter on the pullback/confirmation. Entry rules. You want to see quick sweep, wick through the level. Strong close back above the liquidity level. Momentum shift, bullish engulfing, order block formation. Then enter on retest or continuation pattern. Why this works? You're trading with smart money, not against them. They've grabbed their liquidity, filled their orders, and now they're ready to push price in their intended direction. Strategy 2. Look for liquidity voids. Liquidity voids are areas between major liquidity pools where price can move quickly. After a liquidity sweep, price often runs through these voids to the next liquidity pool on the opposite side. Trading plan. 1. Mark liquidity above and below current price. 2. When one side gets swept, target the other side. 3. Your take profit equals the next major liquidity pool. 4. Your stop loss equals beyond the swept liquidity with buffer. Example. Price sweeps sell side liquidity below recent lows. Now the path is clear to run to buy side liquidity at equal highs above. That's your target, the next liquidity pool. Strategy 3. Multi-time frame liquidity analysis. This is where you separate yourself from amateurs. Daily chart. Mark major swing points and liquidity. 4 hour. Mark intermediate liquidity pools. 1 hour. Mark entry-level liquidity and inducement. The setup. Best trades happen when daily liquidity gets swept. 4 hour structure shifts, break of structure. 1 hour provides clean entry on pullback to order block/FEG. For your confluence, when multiple time frames align on a liquidity sweep, your probability skyrockets. You're trading the same direction as the daily for hour and 1 hour smart money flow. Strategy 4. Trade the rejection, not the level. Rookie move. Liquidity is at 1.1000, so I'll place a sell order there and wait. Problem? You don't know when they'll SW buy it or if they'll sweep it on this attempt. Better approach. Wait for confirmation. 1. Liquidity gets swept, wick through level. 2. Price shows rejection, strong reversal candle, engulfing pattern. 3. Structure shift on lower time frame, break of structure opposite to the sweep. 4. Then enter on next pullback. Risk management. This approach might miss some trades, but it eliminates most losing trades. You're only entering after smart money has shown their hand. Strategy 5. Let's bring it all together. You now understand what liquidity actually is: pools of stops and orders. The difference between liquidity and inducement, target versus bait. Different types of liquidity: external, internal, strong, weak. Where to find it? Equal highs/lows, swings, patterns, round numbers. How to trade it? Wait for sweeps, look for confirmation, trade with institutions. Here's the truth most traders never realize. The market doesn't move randomly. It moves from liquidity pool to liquidity pool. Smart money needs fuel for their big moves, and that fuel is your stop loss, your breakout entry, your obvious pattern trade. Once you start seeing the market through the lens of liquidity, everything changes. You stop being the victim and start being the hunter. You stop placing your stops where everyone else does. You stop entering on breakouts. You start waiting for the sweep, then trading with the smart money. Here's your homework. Open your charts right now. Mark every equal high and equal low you see. Mark the swing points. Mark the obvious patterns. Now watch what happens over the next week. I guarantee you'll see liquidity sweep after liquidity sweep. The question is, will you be on the right side of those moves? If this video changed how you see the markets, smash that like button and subscribe for more smart money concepts. Drop a comment telling me which type of liquidity you find most often in your trading. And if you want to go deeper, check out next video/course/resource. Remember, the market rewards patience and punishes impatience. Wait for your setup. Wait for the sweep. Wait for confirmation. That's how you trade like smart money. See you in the next one.